Well,
thank you all for coming today. It's a real pleasure to be able to lead a panel that I think they asked me to moderate for the first time in the hopes that it breaks this trend of the last 4 years of saying next year is going to get better. And then next year comes around and it's the same old story about, well, maybe we'll see it next year. So I'm enthusiastic that this year is not going to be a Groundhog Day. But let me introduce myself and let the panelists introduce themselves. I'm John Avina. I'm a partner at Cooley.
Hi, I'm Lucy Wang. I'm a managing director in the technology investment banking team at JP Morgan. Been there 20 years covering software and technology companies.
John Christiansen, and partner and co-head of the West Coast business and the financial communications practice at FGS Global.
Alan Denenberg, partner at Davis Polk.
All right. Well, let's jump into it and set the stage a little bit. Talk a little bit about 2025, what we've seen so far. I remember the day after the election, a partner of mine said, well, at least the IPO market's going to be better next year now. And I said, well, why do you think that? Like, you know, the markets hate volatility. We've seen some real volatility this past year with the tariffs. We've seen some positive signs with the Fed easing interest rates and indicating that there'll be more to come. A lot of start and stop as I kind of think about it. So maybe, Lucy, starting with you and kind of how you reflect on what you've seen the last 10 months and what do you think that means for the next 12 months?
Yeah, actually it's been a really interesting year. 2025, if you look at the IPO issuance volume, it's sitting at 32 billion right now. That's already surpassed, you know, the whole of 24, and we certainly still have a few months in the year. So from activity levels, actually been very active. And then in technology specifically, you know, it's been a few years of IPO, you know, drought where we don't see any companies going public. This year we've actually had 21 IPOs in technology going public. And that's 2x of the number of companies since last year. So it's been a great year, and I think we could talk a little bit about, you know, what are some of the profiles of the companies going public, and what does that mean for 26?
Hey, Alan, obviously share your thoughts as well, but we have a government shutdown. We have a lot of companies that are trying to figure out, is there a way that I can still access the public markets in the middle of a shutdown, which, you know, typically you'd say like, no, you just got to wait for it to reopen, but people are getting creative. So I'd love to hear what you're seeing on that front as well as what you think about the current environment.
Yeah, I mean, I'll start with the latter point. I think, you know, the current environment, as Lucy said, is, you know, clearly improved over what it was. There's still a number of things that are kind of weighing against it. You know, private markets are still very strong. Valuations in the private markets are probably still too high. People worry a little bit about IPOs being down rounds. If you look at it, even within tech, it's been a limited number of sectors that have really, you know, driven it. So it hasn't broadened out to what, you know, we hope it will be. And I'm sure John promised next year will be. So we'll see how that comes, if that works out. In terms of the shutdown, you know, as John said, our first reaction is, well, there we go. We're going to have to wait for that to end. But people have gotten creative. The SEC has also been a little bit helpful with some releases, or a release, indicating how you could go effective. And for companies that have already filed, have moved along in the comment process, what people are doing is removing the delaying legend. There's a legend that basically says you have to be on public file for 20 days before you can launch an IPO. And otherwise, it'll go effective automatically. And we would never use that because we'd get an enforcement action if you did it in normal times. But now people are going ahead on the basis that they're comfortable, they're far enough in the comment process, removing the legend, going effective. The SEC is allowing you to do that with a price range under 430A, which heretofore you couldn't have done using 430A. You had to be declared effective. And there's some other creative things people are looking at now. So the SEC, it will, for now, delay companies who haven't started the process and gotten comments yet. But for those who are at least along in the pipeline, for now, maybe people will start doing it without comments. But for now, those companies are at least going ahead.
Yeah, Alan and I were talking before this panel about in the old days that you would get your SEC comments and you would respond and launch your IPO at the same time. But obviously that was back in the 90s when things were much simpler than it seems like they are today. John, what are you hearing, and when you're talking to clients and they're thinking about the markets in general in terms of their ability to access in 26? Any themes that you're starting to hear as you network with different companies that are looking towards the future?
Yeah, I think the market commentary from both Lucy and Alan I agree with, in the sense that I think there's this need to have a little bit more stability before people really feel good about getting public, and there's just more alternatives, and the ability for companies to stay private longer is there in ways that it hadn't been before. There's still an employee element to that and pressure to get some liquidity for employees. But I think there's also in this environment a little bit, it's one thing to get public, it's another to be public. And I think we're still seeing a general reticence on the part of some companies to just go into this market where there's that much more accountability, transparency, visibility. Those are all things that companies always get to and achieve, aspire to. But in a very volatile environment where the regulatory environment, political environment, cultural environment, even in addition to just financial market conditions, all impact these companies, I think there's a general sense sometimes to sit tight, see what happens.
Well, it's a great segue to a question that I didn't prepare you guys for, but I think you're plenty capable of winging this one. But I've been thinking a little bit about this new administration, and we have a new SEC commissioner, Paul Atkins, who came in and said, I want to make IPOs great again. All the things that we read about the declining number of public companies, the declining amount of market activity. And I saw an article, I took some notes on it because it was talking about, he gave a speech recently and was saying that IPOs aren't cool. And why are IPOs not cool, according to Commissioner Atkins? He listed 3 things. He said the cost of compliance, he said the litigation environment for class action lawsuits, and what he called a hostile corporate governance environment, the weaponization of annual shareholder meetings, shareholder proposals, that type of things. And we know that there's been, some rumblings about like, well, are we going to move to semi-annual reporting as opposed to quarterly, and these binding arbitration provisions, which I know the panel talked about earlier today, rolling back climate rules, things like that. And I think he's, talked about a spring cleaning for Reg SK to kind of simplify it from what he thinks has just been, I guess, too much developments on the different rules and regulations that we all grapple with. So, with all of that, Alan, do you think if those changes were adopted that it would make IPOs cool again?
First of all, I would say, John, with John and I doing IPOs, hell, it's got to be cool, right? Could you find 2 cooler old guys? No, I actually don't think that those are, is just one person's view. I think if the IPO market was otherwise robust, that there wasn't a private market weighing down, giving people an alternative, I should say, which has been a little bit of what's gone on for a certain period. I don't think any of those things are really what are keeping people, maybe on the edges, keeping people out of the market, but I really don't think if the IPO is the way to get the way, as it was for a while, to get a great valuation, great liquidity, I think people would do it. And all of those things are just, in some ways, noise.
John, you mentioned that you hear about, it's one thing to go public, but then to be public. So are you hearing a different perspective on that? Or do you think that most people are saying like, yeah, there's like some friction cost of being public, but that's not what's holding us back? What's your perspective and what you're hearing?
No, I do agree with that. I think, again, there's a need to make sure that if you're going to be public, you've got to have a good story to tell. We might talk about that a little later. You've got to be much more transparent with your financials, and then governance reaches a whole new level. But it's the right outcome for many companies. And it's the next, permanent capital, all the things we always talk about. I think IPOs will probably become cool again at some point.
Well, and Lucy, I know like you obviously talk to many more companies on a day-to-day basis than the rest of us. I feel like there's a lot of companies that are, I'll use my word, stuck a little bit and kind of figuring out what their path is forward. We're going to talk a little bit about kind of what the requirements are to go public, but in terms of this topic and how they think about the administration and the posture towards rules and regulations, is that something that comes up, or you're like, no, that's not really a topic?
It definitely comes up, but I think what probably weighs on the private companies is a couple things. One, the flexibility you have as a private company to invest in your business. Think about like longer term strategic just initiatives that you are able to invest versus, I think once you're a public company, I think there's certain thresholds that there's almost like a standard that you're held to. The public markets in the last, call it 2-3 years, has certainly, pivoted from this growth at all costs to be very focused on profitability. So if you look at the public company, at least in tech, most of the companies basically grow and also have profitability, right? So if you're a private company who's growing really fast, have a huge market in front of you, you're like, I'd better stay private and invest in my business versus being public where I have to be thinking about that path to profitability. That's one. Two, I think valuation and a lot of things that Alan mentioned in terms of sort of capital access, right? Those two things used to be, in public markets, most tech companies, software companies trades at 5 to 10 times revenue. That's what they trade at today. But of course, there's people who are trading higher if you're scaled, growth, profitable. There's probably 24 companies who's in that kind of double-digit zone. I was in private markets because there's the scarcity of growth. A lot of the public capital or crossover capital is coming into private market to chase after those assets. So you're seeing this huge difference between private market valuation and public market valuation. So it's like, if I'm a really good company, why would I go public and trade at 5 to 10 times when I could raise capital 20, 30, 40 times in the private markets? So I think some of this sort of market-driven elements that's making companies kind of stay private longer. And but what I think is like going forward, and we'll talk about this in a little bit as well, is that some of these companies, as you get bigger, eventually you're probably going to have to go public. I think it's whether it's employee liquidity or meaning like actually liquidity. I know a lot of companies certainly have a very robust secondary market trading, for private companies, but there's the stock that's trading, there's currency for M&A, there's I think a lot of other considerations where companies at that point is like, I think you're ready to be a public company and you should be a public company. So I'm hoping those companies eventually kind of in the next 2-3 years do come to market.
And we saw a lot of companies in 20 and 21 raise private capital at very high valuations. And Alan made the point earlier that they're kind of a little bit stuck having to grow into that valuation to go public to avoid a down round IPO, which, there was plenty of companies that had down round IPO. Square was a down round IPO and seemed to work out okay, I think. So in any event, I do think, though, that is adding pressure to it. I would note, and even though I'm just moderating and not supposed to be commenting on this stuff, that Alan and I were talking about this before, that even Dan Primack twice in his newsletters in the last month mentioned that the real way to get companies to go public is to revisit the 500 shareholder rule that was changed around the Jobs Act time to basically let the Databricks of the world and the Canvas of the world and the Stripes of the world stay private as long as they can have that kind of access to liquidity. So if you really want to see change, that's what you would do, is actually put more regulation in place, but I don't think that's happening anytime soon. All right, on to another topic, industries to keep an eye out on, keep your eye on. Lucy, let's talk about you. I think about what industries seem to be generating the most hope for better times in 26 than what we've seen. Obviously, the AI model developers are kind of first and foremost with their capital needs and needing to have access to public markets in order to finance their growth and operations. Obviously the AI infrastructure companies as well. We talked a little bit earlier about like fintech, cyber, other areas that I think all of us are hopeful the brighter days will be in 26. What's exciting you for 26 and what you're keeping an eye on for sectors and industries?
Definitely a lot in software still. I know like the narrative, at least in the public market today, it seems quite bearish around software because of the AI risk related to that. But I would say like, especially on the infrastructure side, I mean, in the age of AI, there's going to be a lot of data, right, generated. And anybody who's dealing with that data and, the infrastructure layer of software, I think we feel generally pretty bullish about. And then I think if you think about semiconductors is probably an area that we traditionally seeing a lot of M&A and consolidation, but that's actually an area a lot of capital investments into those areas where we feel like there's probably newer chipset companies that want to compete with the NVIDIAs and AMDs of the world, and that hopefully amounts to some more newer companies coming to market from an IPO perspective.
Interesting. Alan, what's crossing your desk these days?
It's been the same so far, right? It's AI, fintech. There is some for the first time in a long time, semiconductor IPOs, which there hadn't been for many years. I think I've been thinking about like what would be the wave that would follow the I'll call it the infrastructure wave that we're dealing with now. And I was thinking this morning, if we analogize to like what happened in 99, 2000, so the internet got invented by a vice president, and then a bunch of companies took advantage. Initially it was companies kind of developing that, and then a bunch of consumer products and other companies took advantage of that. What could happen, and maybe would be a way to kind of propel the IPO market, is if that next wave comes who now can take advantage of what's happened with AI, and you'll see some of them will fail, some will do well, but the ones that are leaders and innovative and actually develop business models that use that infrastructure that's been developed, we might find a whole new wave of companies, call it consumer AI, I don't know what the right word is, but something like that could propel us, maybe next year, maybe the year after.
And John, are you seeing any kind of critical mass of clients that are coming to you from a particular industry or sector, or have something that kind of is aligned with what we're talking about here that makes you think that's an area to keep an eye on in 26?
I think it's really consistent with what Lucy and Alan have said, where software semis, the big debate, of course, around AI and the infrastructure build is the access to capital, the amount of capital be needed there. But infrastructure, the models themselves, the applications, a lot of activity there. A little bit in and around crypto. I mean, it's sort of hard to know where that's all going to go post-Circle, and that too, like AI, there are flavors of that. You know, the exchanges are very different from other business models, but otherwise consistent with these same themes.
Well, let's talk about what we think are the requirements for going public. And I was joking with Alan earlier that the first IPO that I worked on in the 90s for a company called Ask Jeeves, if anybody remembers the browser Ask Jeeves, it was a really big IPO. It went out in July of 99 off of 98 numbers. Their top line revenue, I won't take a poll, I'll just tell you, because nobody ever guesses right. Their top line revenue for all of 98 was $800,000. These were the days where, you know, eyeballs and stickiness in the .com days were the metrics, the key metrics of the day. But let's talk about like how that's changed. And obviously, I'm dating myself because that's over 25 years ago. But you know, when I think about it, it feels like, and this is a debate I've had with different bankers. So Lucy, I'd love to get your perspective. I've thought, like, you know, you guys use terms like, you know, you have to have durable growth, you have to be at scale, and these terms that I don't really know what that means. But they get put out there as, in my mind, to suggest you need to be at like top line at least 250, growing 30% plus, having some type of free cash flow margin that's, you know, maybe not profitable, but it's trending in the right direction, and that kind of 4 to 8 quarters kind of feedback, a little bit of that rule of 40, maybe it's a little bit weighted towards growth versus profitability at the moment, or maybe not. But, you know, when then I step back from that and think, well, how many companies can check each of these boxes? It's pretty hard. So I'd love to get your perspective and tell me I'm wrong, or tell me that you think about it differently, or it's industry specific. What are your thoughts?
Yeah, I would say, I mean, those metrics are probably, you know, accurate for the moment, but I would say, like, if you look in history, right, IPO market's always open. There's probably for a very short period of time that is closed because of some market volatility, et cetera. I mean, the last 3 years, we've had very few companies go public. I think that might have been, you know, broader macro, but also think about 2021. I think we had 4 times of the normal volume of companies go public in 21. So it's almost like
the cupboards.
Yeah, exactly. So we almost exhausted the pipeline, if you will, for the next couple years. And then I think naturally, in the next couple years, I think larger companies are going public now. I think many of them are, you know, approaching $1 billion or even, you know, $500 million plus in terms of revenue scale. But I would say, like, what investors really look for is, I would say, scarcity value, like what you can find in the public markets. I think today in the public markets, very few companies grow above kind of like 25, 30%. Most companies guiding kind of 20% or like high teens in terms of the forward growth. So if you're a company that can offer outsized growth, that's something that they can't get in the existing market. So that offers scarcity value. I think from a scale perspective, I think that 250 is probably, you know, the right number, or maybe on the lower side, just given, you know, once you're out there, you do have to, you know, beat and raise or at least meet your expectations for the first like 8 quarters. So I think certain companies, if you're not at a size where your revenue is like the predictability of your revenue is there, it makes it really hard for you to kind of have that kind of track record once you're into the public markets. But that said, I think this year, we had some big companies go public, Figmas of the world, right? But we also have smaller companies, whether it's like eToro, whether it's like, I think Hinge Health is not that small, but like I think from a market cap perspective, there's still companies going public between kind of that 2 to 5 billion. So ultimately, it's a bit of this, what can you offer the public investors that they cannot get in existing public companies?
And I think you commented earlier when we were chatting that kind of comes down to valuation. And what valuation are you willing to accept?
Yeah.
Ellen, you mentioned earlier this idea of maybe it's just like the late 90s. So let me ask, you characterize yourselves as the two old guys. I think I'm part of that crew too, but I appreciate you. Not
Definitely are, John.
Unless you're referring to this John and not that John, which,
Yeah, that's it. Yep.
But what does this, what do you think this era that we're in right now and next year reminds you of? I was thinking about it from, in terms of eras, I think of 20 and 21, call it the COVID years. 2015, when the SaaS multiples really adjusted quickly, and I remember, with Box in particular, they kind of got stuck out there for 6, 7, 8 months before they could go public. When people started to say, like, it's not all about growth, that pendulum started to swing towards profitability. 2011 to 2014, when I think about like the Workdays and the Splunks and the Palo Alto Networks and like a lot of, Facebook, like a lot of companies that went out during that market as well. What do you think this era is that we're in now and in next year? What does it most remind you of, or none of the above?
Yeah, I don't know if it exactly fits into any of those in a way, at least how I was thinking about it. The COVID period where we had the most IPOs driven by, stimulus and all sorts of things that, we're hopefully not going to see again for other reasons, hopefully not too soon, very super low interest rates, everything else. So that was kind of driven in an odd way. In some ways, I think, while it wouldn't be exactly the same, but I think the 99-2000, as I alluded to earlier, may be where we were closer to, with the caveat that in 99-2000, and you'll remember this, there were a lot of companies that should never have gone public. It was, all you had to do was have a business. I remember literally going to an org meeting and they were going through like, tell me your 5 points of your plan. Number one is go public. They'd have like a business plan to go public. It was insane. I think we've hopefully have learned a little from that, and these are going to be the companies that do go are still going to be, as I was alluding to earlier, I think will be built off of this new AI paradigm and crypto and the things that are sort of underpinning all of this, but with a much more discerning eye than we had back then. Focused on a lot of the things Lucy said and you said, John, that are driving, profitability together, or a path to profitability at least, a visible one, with revenue growth, with the things that one would want to see in terms of a company that isn't just going to go public, everybody's going to get out, get their money and move on and it'll be gone in 3 years, that you are building a Workday, you are building real companies.
Yeah. John, let's turn to your world a little bit and how you help your clients craft stories, narratives. We talked earlier about how AI is dominating the conversation no matter where you go. And there's kind of call it pure play AI companies, but every company is an AI company at some level. And I'm sure Lucy, Allen, and myself sit through plenty of drafting sessions where people are like, let's tell the AI story. And I think sometimes our banker friends want us to really lean in real hard on the AI story for obvious reasons. But how do you think about AI as a theme for companies that are, have products, maybe some features, functionalities that are AI-like, and want to craft that narrative? How do you think about it, and how do you advise your clients?
Yeah, there's always that desire to latch on to a current theme, and a lot of that is just because you want the growth tailwinds that are associated with these big macro trends. And some of it is, I guess, if we are talking about making IPOs cool again, you want to be a part of the topic of the day. But it does come down to fundamentals. The advice we give is you still need to articulate what is our market opportunity, what are the growth drivers of that market, how is our business differentiated from our competitors and mapped to those growth drivers, and then what does that mean for financials? So as we talk about the various metrics around scale, growth, profitability, you really have to craft a qualitative narrative that foots to those. But if you are benefiting from the mega trends, you have to articulate that too. And so I think it really comes down to what does it mean for your business? is AI a growth driver? And that's where a lot of debate is now around what is the actual return on investment for AI? Or is it a cost saver? And if it's a cost saver, is it a human jobs replacement or not? Does it translate into efficiency in your business and therefore margins? So I think it really just comes down to being genuine about your growth story. And sure, you can try to catch a little bit of the buzz, but only because those are growth drivers for you or cost savers, and not just, I think we're past the point where you can get away with just tagging yourself with the label of the day, because I think institutional investors and everyone else sort of sees right through that at this point.
Yeah, I think the ROI point is really compelling, and Lucy, I'd love to get your thoughts here, that it feels like, I don't know, maybe it's 10, 15 years ago where you could go public and tell a great, what I call it, Act One story. Like your product that's in the market has just been tremendous in terms of growth, and the market's huge for it. But then you also want to, as I say, leave some breadcrumbs for the Act Two story. What's next? But you didn't necessarily have to have proof points that you actually are getting an ROI off of your Act Two story, at least it didn't feel like it. In AI, is it different now, or is the market more skeptical and saying, I understand your AI story, but show me how it's impacting your P&L?
I think definitely more skeptical because everyone, I think from the company's perspective, you have to talk about it, because if you don't talk about it, you don't have a narrative. So you have to go and you have to be really lean in and think about what's your AI story. But I think on the flip side, what John mentioned is investors are going to look at what's the actual revenue acceleration coming from AI. So if you think about the public companies, I think there are a few that are disclosing what's their AI revenue. I think Adobe says they're 200 million of the revenue is AI related. I think Datadog says X% of their revenues coming from AI native customers. So I think there are ways where I think you can give some breadcrumbs on how is AI impacting your business, is really driving kind of the growth adoption or growth acceleration and monetization of that. I would say in general, investors' view is that the jury is still out there in terms of AI, because it's not something you can answer the next 12 months. It's probably longer than that, right? Because if you think about, we go back to the SaaS world where it really took off. It took 4 or 5 years for the largest companies to actually have real acceleration from SaaS. So this is kind of similar. You could say AI is more, people are embracing it more. Maybe you cut that time in half. So I think it's until people start really showing revenue and acceleration from AI attribution. But you do have to have that narrative, because otherwise you would be put in the sort of legacy bucket, and that's hard to fight as well.
Do you find that companies are coming to you with that AI narrative fleshed out, or are you having to really sit down and say, let's unpack this and figure out how we tell that story? How much time are you spending crafting that story with your clients?
Spending a lot of time actually with clients on that. I would say most companies are pretty self-aware, and they know they need to kind of get in front of it and have a narrative. I think it's kind of road testing that with us and thinking about investors' feedback and incorporating, what are other people saying in your space, and what are public companies saying about AI and how they're approaching it. I would say all, if not most, if not all the tech companies that we work with are very much thinking about adopting AI. So the ROI point of maybe is on the cost piece or efficiency piece, and being AI, literate. That's kind of what everyone's striving for. But I think the actual sort of revenue contribution probably still takes some time to play out.
Well, Alan, you and I have to be always the downer lawyers on every panel. So some words of wisdom about how companies should think about AI from a liability perspective as they're preparing to go public.
Yeah, and I think, in some ways, and the SEC has already come after a couple of companies for this, what they call AI washing. It used to be greenwashing back when we cared about the environment. But now it's AI washing. It comes down to really a lot of the same conversation you have about other things, which is, and you'll end up in a drafting session and you'll say, well, wait a minute. Are we doing that, or do we want to do that? And fundamentally, I think if you focus the company, because the company, as people have said, want to lean in doesn't mean, put those things together and make them sound like you're doing them now, even though you want to do them. Talk about what you're doing now. Talk about what your strategy is, whether it's for AI or anything else, separately, making it clear that this is your plan. And then I think the third point is to make sure that plan has some sense of reality. It's not a dream, okay, here are the steps you are taking to fulfill that strategy and make it real.
Yeah. All right, so it's called Capital Markets Crystal Ball, and all we seem to be talking about are IPOs. That's the moderator's fault, so I'll take responsibility. But let's broaden it up a little bit here. And now let me come right back to you. And what's kind of exciting you? Before we were in the green room, you said, I feel like it could be all kinds of things that are going to be taking us through 26 beyond just a new issue market and the IPOs. So tell us a little bit more about what you're seeing there, and because I can't let it go without some kind of IPO commentary, if you think there's going to be any more of these like direct listings or SPACs or other ways to access the public markets for the first time.
Yeah, look, I think what we've seen this year too, and I think there's no reason to think it won't continue on to next year, is huge convert market. The convert market has been on fire for a long time. No reason to think it won't continue to be so. A little bit when interest rates go down, there may be a little bit less incentive to do that, but I think they may not go down far enough that it'll take people out of the convert market. The investment grade market, super hot as well. So I think, the debt markets writ large are still, very strong. So there'll be plenty of that. Whether there are, SPACs, hopefully not. Direct listings, I suspect there probably will be some given the market and given some of the size of the companies and the shareholder base size they have. In some ways, you could argue, okay, well, they fit the profile of a direct listing.
Yeah. Lucy, what about what you're hearing from the market? How many days you spend in IPO org meetings versus org meetings for other types of ways to access the capital markets?
Definitely across the board. I think we're seeing a huge kind of revamp in maybe dividend recap. So from a debt perspective, I think especially private equity-backed companies thinking about that. The market is pretty active. We see a lot in converts. I think a lot of tech companies, even in this rates environment, are still able to get 0 coupons on converts. So that's pretty attractive for many of them. So across the board, but I would say probably a lot more in like sort of IPO dual track as well. So think about using an IPO process to kick off a potential M&A process. You are on the path of going public, but if someone comes with a good acquiring, sort of acquisition offer, you're not going to say no. So people are keeping their options pretty open.
John, what do you think looking into 26 is the one signal, a key metric, a development that you're waiting to see how it unrolls in the next quarter, so that in your mind is going to set the tone for 26?
I think we just need to see a little bit more stability. I think for both the companies in terms of their view of getting and being public, less so on the investment side because they're still chasing the returns that they're seeing in the new issue market. But I think just we need to see a little bit more stability on the political front, the interest rate front, and the macro front.
Any comments from Alan, Lucy, on what you have an eye on for a key indicator?
Really think about, hopefully, rates environment and, more clarity in the next, couple of months. Hopefully economy holds up well going into 2026. The percentage of recession is coming down, at least all the, at least according to JP Morgan's economist. So that's positive. But I think there's also kind of question mark around AI. Is that if that really hits, and from an acceleration perspective, I think there will be a very vibrant market.
Yeah, I guess I would say what I would know we're in a good market when good, not great, companies go public and trade up. Then I think we'll be in the middle of a wave, because most companies are good, they're not great, and that once those start to go public and do well, we'll be in the thick of it.
Yeah, if they can do it, we can too, kind of thing.
Yeah.
Yeah.
I think we're right in the middle of where the key indicator for me is the number of RFPs that are coming in, because you have to be orging up now if you want to go out in the spring, which is always, the birds fly back up north, and the IPOs seem to happen in March and April. Not to say that there aren't other windows, of course, but that always seems to me to be a good indicator of what to think about for 26. So we have just a minute left here. So the lightning round question that closes out, and Alan, I'll start with you on your end, just to prove how much you have conviction in my abilities as a moderator to predict the capital markets in 26. In fact, that's probably the leading indicator, is me moderating this panel. How many tech IPOs do you think we'll see between today and the next a year from now when we're sitting up on this stage?
Yeah, I'll be optimistic. I'm going to say 65.
Ooh.
I think John's coming in under that.
I was the under on that. I'll take 50.
50. You're pressure. You can't be less than a lawyer.
This is my job. Well, we have 20 this year so far, right? I think we'd be happy if it's at 40 next year.
So we have a panel where crusty Alan Denenberg has the most optimistic view on the number of tech IPOs and the lowest IPO prediction from an investment banker. All right, so I appreciate all of you guys spending this time with us. I hope you guys learned a little bit from the wisdom up here on the stage. And thank you very much for coming out today.
Thank you.